Hey Bowtie Nation, Joseph Hogue here with not only a great video for you today talking about the top 10 most popular dividend stocks, but also a question for all you out there in the community. You know, we usually talk about following the crowd as a bad thing, but can it sometimes help us pick the best investments? I mean, the 10 dividend stocks I'm going to show you today are held by thousands of fund managers and are the most popular stocks among retail investors on Robinhood. So if you could invest in a stock that had been poured over by thousands of analysts, professional money managers, and investors all coming to the same conclusion that this stock is a buy, why wouldn't you? So let me know in the comments though, what do you think? Does investing in the most popular stocks gives you some kind of safety in numbers? By the way, here's a fun little experiment in following the crowd. Stand on the sidewalk and just look up at nothing for several minutes. Time yourself and see how many people stop and look up with you in 3 minutes. My record is 10 before someone calls me an asshole. We're getting started, but before we do, I've got to send that special shout out to all you out there in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Now for our list, I screened for dividend stocks with a yield of at least 2.5%, because if they're not paying that, then it's really not a dividend stock in my book. I then filtered for those held by at least 2,500 money managers, which left me with about 16 stocks and a pretty solid list of dividend stocks in itself. I then narrowed this down by the top 10 stocks held by Robinhood investors and ranked them by most popular for regular investors. The 10th most popular dividend stock, which still makes it one of the most popular in the market, CocaCola, ticker KO, with its 2.76% dividend yield. Now, Coca-Cola has only grown its dividend by about 3.5% annually over the last 5 years, but it's hard to argue with this kind of brand leadership and the cash flows. Almost 3,400 institutional managers hold these shares, with Warren Buffett's Berkshire alone holding $23 billion, or about 9% of the company. Other big owners here include Vanguard with almost 8% of the company, and BlackRock with 6.5% of the shares. And of course, these are all in the ETFs managed by these companies. I was actually a little surprised at the valuation on this one, trading at 7.1 times on that price to sales basis. Now, it's true that stocks in the consumer staples sector tend to trade at higher valuation because investors are just willing to pay more for that stability in cash flows and the dividend payments, but 7 times sales, that's in growth stock territory. In fact, I was trying to find a way to justify this valuation in the sales growth or some other fundamentals, but the company has actually seen its revenue steadily decline as it consolidates its products. Revenue has fallen consistently from $48 billion in 2012 to $41 billion in 2016 and just $38 billion last year. Now against that, operating profits have increased from $8.6 billion in 2016 to about $11 billion last year, so it is getting more profitable, but it's just hard to overlook that declining trend in sales. Analysts do see a brighter picture though, with an average target of $67 a share, or about 6% upside over the next year on top of that dividend. So like most of the popular stocks we're going to see, probably not going to shoot the moon higher, but it is going to produce that dividend and maybe a little extra return. IBM hasn't done much on the stock price, especially since topping out in 2013, but a lot of investors love that 5.1% dividend yield. Investors have been watching for that turnaround in IBM for years, but this is another one that has seen its sales decline from $80 billion in 2016 to just $57 billion last year. Operating profit has halved from $13.2 billion 5 years ago to just $6.8 billion last year, and it's meant the company could only raise its dividend by 1.8% annually over that period. But almost 2,900 institutional managers holding shares of IBM here, with top holders again Vanguard and BlackRock. Now we're going to see that in most of these widely held dividend stocks. These are the two largest providers of exchange-traded funds, ETFs, and many of them just invest in those mega cap index heavy stocks. And what's interesting here is that at one point, Warren Buffett held the most shares, but hasn't held any since 2018. Now we do see quite a bit lower valuation compared to Coca-Cola, with a price to sales ratio of just 2 times sales, but even that is still 22% higher than the 5-year average. And look, nation, honestly, I'm not trying to shit all over these stocks, especially since I know a lot of investors own them. I don't know. I think maybe it was just luck of the draw that the first two here are a little expensive when you consider the trend in some of their other fundamentals. Analysts are still holding out hope, though, with an average target of $144 a share over the next year. That's about 13% upside, and Kyle McNeely at Jefferies has a target of $165 a share, which would be almost 30% return plus the dividend. Now, honest, I'm not going to poo on all of these stocks. In fact, I own 5 of the dividend stocks on this list, so about 50-50, but I want to see how really popular these are. So click through the share button below and share it on Facebook with how many of these stocks that you own. Be sure to tag me in your post. Chevron Corporation, ticker CVX, is our 8th most popular dividend stock. And looking at this graph, you see the amazing run the stock has had, up 70% on higher oil prices just since mid last year. In fact, this used to be a 5% plus dividend stock, but the share price has just run so high and so fast that the dividend hasn't been able to keep up. It's still paying a respectable 3.3% dividend yield. Management has increased the yield by 5.6% a year, and I expect it to go up at least by that much or more this year. Almost 3,400 institutional managers hold the fund, and some really big holdings here from those non-ETF providers like Warren Buffett's Berkshire and Bank of America. Even the Norwegian sovereign fund here owns 1.4% of the company. Now, with the 70% increase in shares, you would expect the valuation to be a little stretched on this one. Chevron trades for 2.1 times on that price to sales ratio, which is about 33% above the 5-year average. And the cost of production is around $40 a barrel though, so with oil as high as $100 a barrel, this is still a cash flow machine. And of course, it would figure that the first stock I own on the list, analysts have an average target price 3% below the current price, but it's just because this one has run so fast in that boom in oil prices. I'm up 140% on my shares of Chevron, and that's only since late 2020. I don't think there's much price return left, but those dividends are just going to keep on growing. So I've sold some call options against it and am holding those shares. Finally, a stock on the list that may actually be a value pick, a shares of Verizon Communications, ticker VZ, and its 4.8% dividend yield. Now, shares of Verizon trade for about 1.6 times on that price to sales basis, which is only about 4% below the 5-year average, but hey, I'll take it. Revenue has increased from $126 billion in 2016 to over $133 billion last year, so increasing though only about a 1% a year, which is something you would expect from a mature business like telecom. The problem here, and you see this across the carriers, the telecom companies, is that they're paying for that 5G band auction last year just blew a hole in cash flows. Verizon alone paid $45 billion for the C-band auction, and it's contributed to a pretty low 2% annual growth in the dividend. But I like the telecom stocks here because now they're starting to see that payoff on the 5G investment. Revenue growth should accelerate over the next few years, and this is a relatively safe industry in a recession, so stable cash flows that can continue to crank out that dividend. 3,600 institutional managers holding shares here, including Berkshire with almost 4% of the company and an $8 billion investment, along with the usual suspects of ETF providers. Analysts only have an average $60 target, or about 13% upside, but even that low target is above the current share price, so a nice vote of confidence for the stock. It won't make you rich, but it will continue to put cash in your pocket. Another stock I own here, and one in our 2022 Bowtie Nation portfolio, Citigroup, ticker C, and its 4% dividend yield. More than 2,400 institutional managers hold these shares, with 77% of the shares held by those long-term investors. The dividend here has grown by 26% annually over the last 5 years, though that was off a low base from the Great Recession, so I wouldn't expect that kind of growth going forward, but it has increased 6.5% a year over the last 2 years, which is still a solid dividend growth. Now, all the bank stocks have sold off recently on the recession fears, but Citigroup even more so because honestly, the bank hasn't been as well run as its peers. Revenue has been flat for about a decade at about $72 billion last year, though earnings have been growing. The real story here, and this is why I own the shares, is the valuation. Citigroup trades for just 0.5 times on that price to book value, and that's really the measure you want to use with these banks, price to book instead of price to earnings or price to sales. That 0.5 times multiple is 32% below the 5-year average, and really the cheapest bank stock in the mix. The stock was trading as high as 0.95 times book value in 2019, which would be almost a 100% return from here. The problem with Citigroup is that it's grown to a point where it's really hard to manage, so it is selling off a lot of its non-performing consumer units, especially in the Asia-Pacific focused business. Selling these is going to help it improve profitability and take that price multiple higher. And analysts agree with me here with a $71 average target, more than 40% higher than the current price. This is another one where even that low target is a positive return on top of the dividend yield. We'll get back to our list, but I also want to personally invite you to get the weekly Bowtie, our free weekly newsletter with all the stock market news, strategies, and trends you need to know. Each week before the market opens, I'll show you what I'm watching and the stocks that could highlight the week. It's all completely free, just something I like to do for all you out there in the community, so look for the sign up link below. I recommended Gilead Sciences, ticker GILD, last year before the price went up 13% on top of the 4.7% dividend yield. Now, shares are back down recently on problems around its strategy to diversify its pipeline of drugs from really that focus on HIV and hepatitis into cancer treatments, but this is still one of the best stocks in drug makers. Gilead has a commanding lead in HIV drugs, where it serves 80% of the patients in the United States and really locking in that cash flow. The dividend has grown at a very strong 7% annual pace over the last 5 years, and more than 2,200 institutional managers own these shares, with 83% of the shares outstanding held by big money investors. And this is one of those companies that is always discovering new drugs, and revenue has started to recover, up 23% from the 2018 low to $27 billion last year. Now, it's still down from $30 billion in 2016, so the shares have been pretty rocky here, jumping to as high as $84 each in 2020 to as low as $57 each recently. Now, that uncertainty, though, has made it for a good value play, with the stock trading at 2.9 times on the price-to-sales basis. That's more than 20% below its 5-year average. Analysts expect it near $71 a share over the next year, for about 13% from here, though the low target would be back down to $54 each. We're down to the final four here with ExxonMobil, ticker XOM, and its 4% dividend yield. Now, with all the talk around ESG investing and the environment, you might expect fewer funds to be holding oil stocks, but these are still very popular dividend stocks and just cash flow machines over the last year. Nearly 3,500 fund managers still hold Exxon, and it's not just in those indexes, but in a lot of these theme ETFs as well. Now, Exxon pays a little higher dividend yield versus the 3.3% yield we saw with Chevron, but has only grown its payment by 2.7% annually versus that 5.6% growth we saw with CVX. Now, some of this, and the reason I own Chevron instead of Exxon, is the production costs. While Chevron's average break-even per barrel is around $30 each, Exxon's fields are in those more expensive plays, and it's closer to about $50 per barrel on its break-even. And that means two things for investors. One is that Chevron is likely going to remain profitable even if oil prices crash lower, so probably the safer investments. But it also means that shares of Exxon typically produce a better return when the oil prices go up. As oil prices move well above that cost of production, shares of the riskier company tend to do better. And we see that risk dynamic play out in the valuation as well. While investors are willing to pay a price of 2.1 times the annual revenue for shares of Chevron, the price to sales for Exxon is only 1.34 times. So because of the higher cost structure and the less efficient production, investors just aren't going to pay as much for these shares. Now, the current valuation for Exxon is only 13% above its 5-year average, so maybe not quite as expensive as shares of Chevron either, though. And just like we saw with Chevron, analysts are hesitant on the upside after a 43% jump in the shares just this year. The average target here is just 3% above the current price, and one analyst sees it down as low as $75 a share. AbbVie, ticker ABBV, is one I've recommended several times over the past year, and this is gonna break my heart to say it here, has just gotten too expensive. Shares of the drug maker are up 62% in the last 6 months alone, and the dividend just hasn't kept up. This used to be a 5% plus dividend yield, but is now paying just 3.2% because the share price has run so hot. What's even crazier about this is the company has increased the dividend payment by 17% a year over the last 5 years, but still just can't keep up. And that probably won't mean a lot to the 3,600 fund managers holding these shares because these are all long-term and index investors, and it's still the same great company, just really expensive. Now, that doesn't mean the company won't continue to pay out that dividend. It's still a best-in-class immunology drug company with a pipeline in oncology and eye care as well, but shares trade for 5.5 times on the price-to-sales basis, 29% more expensive than the 5-year average. So I wouldn't expect those 62% returns plus the dividend every year. And analysts are a little worried here as well, with an average target that's 11% below the current price. Even the highest target price of $192 a share is less than 10% higher. Philip Morris International, ticker PM, is another controversial one, but still extremely popular for its 5% dividend yield. Now, Philip Morris got the international business when it was spun off from Altria in 2008, so this is sales outside the United States, and mostly in those emerging markets where cigarettes aren't quite as restricted. Now, still though, management has set a goal for half the revenue from those non-combustibles by 2025 just to reduce the risk around traditional cigarettes. Now, I'd say they're probably not likely to meet that goal, but it is in the right direction. And ironically here, it's in that aggressive push for the company's heat sticks and early leadership in it that is rewarding the stock with faster growth versus the more traditional tobacco companies. Philip Morris has been able to grow its sales at 3.3% annual rate since 2016 versus more like 2% annual growth for its competitors. And despite that public perception, this is still held by almost 2,400 fund managers, all loving that safe 5% dividend that's grown at a 3.8% annual rate for years. Shares trade for a 4.97 times on the price to sales basis, just 4.4% above the 5-year average, so not really cheap, but not as expensive as some of the other stocks on the list. Analysts have a target price of almost $108 per share over the next year, about 8% higher from here, with a high target of $115 each. This next one may or may not surprise you. AT&T, ticker T, is still a very popular dividend stock for its 4.6% dividend yield, though the shares have done nothing but fall over the last few years. Now that 4.6% yield is a new dividend yield, lowered after the spinoff of the Time Warner assets, so it's going to be interesting to see if investors drop the stock. It used to be paying something like a 7 and an 8% yield, but of course that just wasn't sustainable. The sale of DirecTV assets a few years ago and now the spinoff of Time Warner makes AT&T once again a pure play telecom carrier. It's paying down a big chunk of its debt with the spinoff proceeds and is going to be a more focused team now. I actually picked up the shares in January after years of hating on this stock. More than 3,000 institutional and fund managers own this stock, and most of these are those ETF indexes and dividend themes, so they're probably not going to drop it just because the dividend yield is lower by a few percent. It's still one of the highest dividends in the list and in the market. Now, in the past, because of the cash flow problems around so much debt and trying to reinvest in that Time Warner group, the dividend has only grown by 1.2% annually over the last 5 years. I expect that to increase now that it's a pure telecom, at least up to the 2% dividend growth that we've seen at Verizon. And it seems analysts are optimistic as well, with an average target of almost $29 a share. That's 20% upside to the stock, above the new dividend yield. Don't forget to share how many of these stocks you own, or click on the video to the right to see my 7 largest stock positions, 7 stocks I've invested over $250,000 in my own portfolio. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.